Hey there, it's Bill with Smart Trades. It's February the 24th around 11:40 a.m. Pacific time, and stock market coming back a little bit here as expected based on the breadth ratios, which I've been mentioning throughout the day to my followers on Twitter and also at smarttrades.com. At any rate, I think we may have 5 waves down off the top. And again, as I'm always looking for divergences against the trend with breadth ratios, and on a short-term basis, we're getting that, and possibly 5 waves down. Ideally, we're going to see a bounce. It could take us back to about 1318, maybe a little higher, maybe 1325, 1326, basis the S&P cash. But I think this market has topped. I think an important top, perhaps, intermediate at least, and I'm looking for lower prices. At any rate, if you had been following my suggestion to sell against the trend line tests with bearish breadth divergences, hopefully you've been short and have gotten short, and at this point you have a chance to already take a partial profit and bring your stop to break even, locking in a profitable trade. If you had again shorted against this trend channel, you can connect these highs here. This is the longer term channel, but you can connect this near term channel, and you'll see that indeed any of these places where the market touched the trend channel and you had bearish breadth divergences, you would have had a nice trade off of those highs. We've broken the lower portion of that channel. Again, I think this market has topped. Here is the longer term view of the advanced decline line, and indeed we have a downtrend channel on the breadth ratios, the advances on the NYSE to be exact. I'm expecting a short-term bounce, but I think that's a bounce that I would look to sell into, assuming that it indeed turns out to be corrective. Here's another view of that same chart, basically. And one thing to note here is that unlike this previous decline where we had a nice sharp decline, it's very difficult from an Elliott wave perspective to make any sense of this as a C wave, as you could have back in late January. With that in mind, I don't think it is a C wave. I think that we've indeed, this is a wave one down, and I think the breadth ratios are indeed this channel, I should say, to the downside in breadth ratios is indicating a change in trend. Those of you that have watched for a while, if you'll remember back in September of last year, we had a bottom. We had just the opposite scenario where the breadth ratios actually were starting an uptrend while the market was still in the process of turning up. That produced this terrific rally that we've had over the last several months. So what gets you long should also get you short, and right now we have an inverse pattern to that September pattern, and it's bearish, and I think we've topped. You can see this even more clearly. This is a somewhat dated chart, as is the last one. Here's the the Nasdaq advancers, and you can see that channel very clearly to the downside, and indeed what I think is a wave one down, and we're going to have a wave two back up, and then off we go to the downside again. You can again see the wedges. You can see connecting the dots that you could have gone short against that trend channel with a rather obvious bearish divergence on the breadth ratios. Here's Apple. I had talked about a little 1-2 up here of the first wave down, and indeed that's the way it's turned out. We're down, about 30 points on Apple off the highs. I do think Apple looks like it's ready for a bounce. You can count 5 waves down at this point, possible A back up, maybe a B back down. The volume and the momentum are lightening up, so perhaps a bounce back to 350. No guarantees on exactly how high it's going to get. I would be concerned if we took out, say, the 360 mark, that resistance that I had mentioned. We actually topped at 359.50 here on wave 2. I had targeted 360. A little shy of my target, nonetheless, a good chance to get out of Apple or get short, or as I suggested, that little window into the future as Apple was leading the way down before the broader market had actually peaked. Now, Here's something very interesting to me. This is a chart of unleaded gas, and as you can see, we've had quite a substantial rally. We're almost back to the 2008 highs. Indeed, this rally from low to high is about a 250% rally. It's rallied from about 80 to about 280. Pretty phenomenal, particularly given that the rally in crude oil has only been about 65%. We've rallied from about 60 back to 100. Moreover, as you can see here, this is a semi-log chart, so it's kind of mutes the actual shallowness of this corrective rally. The rally looks corrective. We may go a little higher. We may go up to about 110 at the top of this channel. As I've been mentioning all along, I think that this is a channel-bound market, and the idea is to buy at the bottom of the channel, sell it at the top. It's interesting because this morning around 3 a.m. I got an email from somebody that's been telling me that crude oil is going to 150, and he was gloating because it hit 100. Something just to always keep in mind: try to keep your emotions out of your trading. You want to look at the technicals. Right when he's gloating about crude oil, he probably should have been taking a near-term profit and looking to perhaps buy on a corrective pullback. Nonetheless, the market has hit the top of the channel. It could go higher from there. Certainly, we've got a lot of unrest, obviously, in the Middle East, a lot of uncertainty there. Imagine if Saudi Arabia were to go into chaos. Certainly, crude oil would go ballistic in a case like that. I don't necessarily see that happening. In fact, in the long term, some good may come of all this unrest in the Mideast in terms of all kinds of democratic reforms and so on and so forth. But far be it from me to predict what's going to happen there. I certainly don't know, and things could go sideways or screwball or whatever in the Mideast, and obviously that could have an impact on crude prices. Here's the weekly chart of crude. Again, just connecting. This is a parallel channel based on this longer term channel at the bottom. We are right at it here. We could go higher. We could go up to about that 110 level and test the top of the longer term channel. And wouldn't be a shocker, again, given the unrest in the Mideast. But nonetheless, the big pattern is a corrective one. Here is USO. This is a crude oil ETF, even more precisely hitting the top of its channel, and so far hanging in there, not taking off above that channel. And this is a weekly chart of USO, and this is not the semi-log scale. What's remarkable about this, when you look at the overall pattern, it is so corrective looking. The market is really, really weak. You see these short-term blasts, and it feels like crude is going to the moon, when in fact it really is not. It's in a channel, a corrective channel that has trended up from the lows in 2009, but nonetheless the pattern is clearly corrective so far. If we go blasting through the top of this channel, again, if something absolutely wild happens in the Mideast, certainly I'll be the first to say that look out above. But so far, it hasn't happened. Bonds. I thought we were going to go a little lower in our fifth wave here. So far, it looks like we've actually bottomed in wave 5 of 1. I think it's 1, or it could obviously be an A wave to the downside as well. Previous fourth wave resistance comes in around 122 and 8/32. I think that's probably going to at least give the bond market a pause. That said, I think the bond market's going to work its way higher over the coming weeks. If you see a corrective decline there, that might be a chance for a short to intermediate term buy in the bond market. But for now, I'm thinking perhaps a little bit of a pullback before the bonds work their way higher. Here's a bit more of a close-up of the bond chart, and again, possibly a finished wave 1 or A wave to the downside. Previous fourth wave resistance comes in 122.8. Euro, as expected, ABC decline leading to a rally. We could still have some room to move to the upside. Perhaps 142, 144. I'm not going to even hazard a guess yet. It's too early to do so. That said, this looks like a corrective decline. The rally is fairly strong. It's possible that this is just a larger A wave and a B wave will peak up here. But I think on the surface of it, I'm going to stay moderately bullish here on the euro, and more bullish still in gold. Gold looks like it's almost certainly going to rally some more, but you never know. So you always use stops and so on and so forth if you are trading it. But and in fact, we are perhaps getting near the top of a third of a third here. That said, if indeed this short-term count is correct and this was a fourth wave, we've got somewhat higher prices to potentially substantially higher prices to come in gold, and so my inclination would be to look for corrective declines to perhaps buy into, keeping in mind that ultimately we're probably going to see a top up above here in gold long term, but for now it looks like it's got some more upside. Anyway, thank you so much for watching. If I don't do another video, have a great weekend, and thanks again. Have a good one. Bye-bye.